crypto is a scam? Who actually runs the Wall Street?
I mean, it's a very complex beast. Financial advice. So you want to get me to jail? Just don't build a scam.
Hello, Michael.
Hello. Thank you for having me.
Michael, let's kick off with your story. Tell us about your background.
Yeah, it's pretty adventurous actually. I don't know where to start. So academia-wise, I'm a bachelor in marketing and I got my master's in finance in Germany in the business school. And meanwhile, I was studying finance. I also was selected for a portfolio management program, which was running by a Swiss fund, which had like 2 billion euros assets under management. And they were like looking for promising students for their main fund, and they were giving out 1 million euros to the students just for them to manage it for over the course of 2 years and see how they perform and mentor them as well. So I got into that program. So for 2 years I was managing this 1 million euro, and like every Friday I had a mentorship session with different portfolio managers from the main fund and professors as well. And in the end, yeah, I got the first place actually. My team, we invested purely in equities and bonds, no crypto. I was advocating for a long time just to invest in crypto, at least in Bitcoin. It wasn't possible. There were no rails for doing so at those institutions. And so basically I had the opportunity to climb the corporate ladder within the traditional finance world, and but the crypto market was attractive enough to kind of steal me from the traditional market. So I started my actually, it started from the crypto fund, like a small crypto fund with my friends from Ukraine. I was doing that for another 2 years after all this traditional finance stuff. And then I've decided that it's time to conquer New York. And I went to New York. I was living in Manhattan for like a bit over a year and a half. And I was building the Starbridge fund. So basically a crypto fund where we connected with like literally prominent, like all the best funds within the industry and all the best startups. Like they all based either in like if we are talking US wise, either in New York, in Williamsburg. Yeah, I think I went over the line like with my story. I got like lost into the trenches. So yeah, you can feel free to interrupt me because I can go on and on. So yeah, I think it's in a nutshell. Well, I actually haven't mentioned the fractional CFO. So yeah, meanwhile, I was dealing with startups just because I know financial modeling and I know like how to make like projections and basically any kind of like DCF or whatever model it is. I've realized that founders who are primarily coming from tech or marketing, they don't have the financial acumen. So I help them with their financials basically, and it kind of grew like a snowball. I haven't advertised it anywhere. It was just like a purely referral base. I've helped like 10 plus clients with financial models.
Cool. Really, you have such a different and various background, I should say. Really, it's really cool. So from marketing to financial side of things, that's amazing. So you have actually good understanding of how to build startups. Because when you're building a startup, you have to understand how to promote it, how to advertise it, and also how to run the boring part, which is finance. And it is
It's not
interesting
boring
that
to me
you.
though.
But for many people, it
Yeah.
is actually really boring. So you had experience of living in New York, and it is very interesting about states right now because they are turning to like this mass adoption of Bitcoin, and crypto institutions are becoming more crypto friendly. Do Wall Street guys still think crypto is a scam, or are they actually getting it?
Yeah, they actually are getting it. So I've been to lots of meetups. Like in New York, every other day is there a meetup, either on Bitcoin or TradFi, or I mean, you can find any meetup based on your preferences. So I went to tons of those that were run by finance guys on Wall Street, and so I would split it into two parts. So I met a lot of investment bankers and like basically people who TradFi who actually are dropping their careers in TradFi, and they move their careers back into crypto. So they join like Coinbase, so they start their own startups. Another part is that those institutions are adopting Web3 themselves. So the problem with Web3 and TradFi I mean, say New York institutions landscape. It's usually very complex and very regulated. So it's not like the same happened to me when I was at the Swiss fund. So even though I wanted to buy Bitcoin and I was a portfolio manager, right? I have the authority to buy stuff. Basically there were no rails to do so. There were like interactive brokers, UBS, any kind of bank. They didn't have the Bitcoin ETF to buy it. So you literally cannot buy it legally wise. And now it's possible. And even more though, those institutions, they build like staking platforms that on the back end are purely traditional finance companies. So they run TradFi algorithms, they run TradFi strategies, and on top of that, they as a source of capital, they build this staking platform. So it's very emerging, and the Wall Street old infrastructure is dying. So a good friend of mine with whom I play chess a lot, like every other week, he's MD at Morgan Stanley. Very smart guy. He's like a PhD in physics, and he was a lecturer at Harvard and MIT. And he says that my job is not going to be existing in like 10 years or like 15 years. They're going to go obsolete. Crypto is actually providing way better infrastructure than the TradFi. So it's actually, it's going to be a new world, I think. And Wall Street is getting it.
Really interesting. And so basically, you're saying that right now, like this institutional adoption is actually that crypto companies are turning to Web3 models, and they're trying to use like the crypto in their, like not the crypto but crypto ETFs in like more and more often, right?
Say Tether, right? Tether it's one of the biggest shareholders of the US Treasuries. It's even more than BlackRock, I believe, at the moment. So the problem with this TradFi infrastructure on Wall Street is that it's only accessible for the US users. So if you live in the US and you're an accredited investor, which basically means that you make over $250,000 a year, then you can access this whole infrastructure. But otherwise, you can't, and the only option you have, if you're outside of the US, say you live in Ukraine or Poland or I don't know, in Africa somewhere, uh, go. Good luck buying some options on via Morgan Stanley or some derivatives via Morgan Stanley. It's impossible. But crypto rails can provide that. So and I think that the whole world is actually bigger than the US, and the crypto rails are suitable for the whole world. So it's gonna take over even though it's a good infrastructure, it's very limited for its participants. So, and banks also they see that they're gonna miss out. So if they want to adopt, they're gonna be obsolete. So it's like a power play at the moment. There is a company called Ondo Finance, which is run by purely old financial like TradFi background guys from like investment banks and hedge funds. They basically, as I mentioned before, this business model where it's a staking platform where you can stake your assets, but on the back end it goes to treasuries, it goes to bonds, it goes to like traditional finance instruments. So Ondo is a new Morgan Stanley basically.
Cool. And what do you think about Mika? Because you say you mentioned Tether, and that it opens the opportunities. Like it opens basically, crypto opens a traditional market to investors from the whole world. But what is your opinion about Europe right now? Because it's definitely lagging behind the rest of the world in terms of their innovations and other things. What do you think about Mika regulation?
I think this is my weakest part, the regulations and this law stuff. I'm not that deep into the trenches in terms of law understandings or regulations but on the other side, I like my network of people who are into crypto. I mean, they're unstoppable. Like there is no legal act that can prevent people from using their crypto infrastructure. So I think that regulate it's impossible to stop the crypto movement. So I'm not that familiar with like particulars of the law of Mika Act, but on the other side, I understand that no such act can influence crypto that much because crypto is decentralized. You cannot stop decentralization. China tried it. I mean, failed. It's impossible.
Yeah, in China they actually have a lot of startups and a lot of people who are working for crypto companies, but they're
Exactly. Yeah.
hiding their identity not to show that
Yeah.
they are doing this to the government. So, Michael, let's move to fractional CFO. So you mentioned it previously.
Yep.
Can you tell us what is it anyway?
Yep. Sure. It's basically providing clear understanding of the business number wise. I'll say an example. There is a, say, marketing agency in New York, which is run by marketing people who understand how to build different SMM strategies and stuff alike. But their financials is a mess. So they basically input manually into Excel their clients, their revenues, their costs, and it usually not labeled properly because they don't know the standards, right? Fractional CFO is basically the guy who's responsible for making everything clear and provide the financial guidance on where the business is going numbers wise. I think in the nutshell, basically.
I see, I see. And as a person who worked with many different startups, what is like the main problem that you see? So you come to work, especially if we're talking about Web3 companies. So if you come to a Web3 company, they hire you as a fractional CFO. What is usually the biggest problem in terms of finance, what they don't understand?
Exactly that lack of understanding. They don't know what should be into this. So they just basically don't know how they cannot predict another month of their business. The absence of planning, the absence of budgeting. So they just basically have a rough idea, but when it comes down to numbers, they get very surprised when the numbers are become real. So basically, the period has passed which they planned, and it's way off. The variance is huge between like planned and actual numbers, and they are their biggest, I would say, blind spot in that regard is that they are just basically lack of knowledge of the models of how to do so. A lot of them they don't know how to use even like Excel or Google Sheets, like the formulas they might use, and they don't need to. They have other skill set. It's basically getting them to understand that there are answers to their questions, because there are lots of businesses who already been through their challenges and it's been solved. You just need to basically do it for your startup. So it's basically just the educational part, I would say, just to make them know that it's possible to do so.
And what about the, let's say, established Web3 companies? If we
Yeah.
like, there are a few actually already on the market. Uh, what do you think about them? Do they have they got it sorted out, or do they still have some problems with it?
I mean, depends on different sorts of companies. For example, FTX, they used QuickBooks, which is used by small startups to run their accounting. And I don't mind anything. I don't have anything against QuickBooks, but yeah, um, I haven't, so I wasn't fractional CFO for big companies because it's a whole different skill set. Not different skill set, is whole different, I would say. Skill set is the same. Basically, the models are the same. It's just they have at their scale they have everything figured out. I haven't built a career in there, so it's basically they don't. If they already big, it means that they already have those. They already have those CFOs in place, and I'm working with the new startups who trying to get there. So I'm focused on a bit different niche. Uh, but I think that yeah, the pretty established companies they have everything sorted out. They have to, otherwise the business wouldn't work.
So you think that FTX failed not because they had some
Yeah,
poor understanding of like a source
yeah,
of finances, or how to like where the finance comes from, so how come from, how much they have earned, and so on and so forth. So you think they had them had you think they had everything sorted out?
yeah. I think it definitely wasn't an accounting error. It wasn't an accounting problem. It was a SBF problem. I know lots of stories about SBF, even from Alex Pak, who is our So we basically worked with Hack VC, which is run by Alex Pak, who invested in Alameda early days, and he got also an opportunity to invest in FTX when it was starting, but he basically dropped the investment because the problem was FTX and SBF that he is very overconfident and he's not doing he's not doing his books in the legal way. So he basically mixed financials of two businesses. It's not that he wasn't doing proper planning and stuff. He basically broke the law by getting Alameda money into FTX, which is a separate entity, and then Alameda got under the bus basically, and dragged the FTX after themselves. So it was basically illegal wrongdoing. It wasn't the absence of planning. He was basically breaking the law.
Okay, I see. But I'm not really sure he was understanding what was happening back then. And I think that
I mean,
this
yeah,
is also.
as I mentioned, he was doing his books into QuickBooks. It was like a $30 billion business, which is run in the QuickBooks, which is software for small startups to make their books clean. It's like, yeah, I think that at that level you have to have a more professional team of like a CFO unit, like with bookkeepers and accountants and CPAs and the like. But yeah, the problem is that he basically broke the law by mixing finances of two businesses, which was separate entities.
Yeah, yeah, I see. Right now, let's zoom out a little bit for a second and talk about traditional finance. Crypto guys often refer to traditional finance, to some stuff on their Twitter. Could you tell us how it actually works and who actually runs the Wall Street?
Who runs the Wall Street? I mean, it's a very complex beast. There are tons of structures, and I mean, in a nutshell, Wall Street runs by its investors. Investor invests in the different investment vehicles, which is run by investment managers. And investment managers, they also can be referred to general partners and investors as limited partners. So it's basically the basics of investment vehicle. And GP or investment manager built a product that is investable and that is in somehow risk optimized, I would say. So each product has a risk to reward, and there are tons of kinds of investment vehicles like private equity funds, hedge funds, traditional asset managers, pension funds, global macro, arbitrage, and things alike. And basically anybody who has its own thesis or its own idea of how to capture some value in the inefficient markets can build this investment vehicle and attract money from LPs or investors and invest those assets into trading algorithms or investment algorithms. And on top of that, there is ACC who oversees that there is no wrongdoing and everything is transparent. And that's pretty much the structure. And the biggest, like the best offer wins, right? So at the moment, the best offer is in Web3 because this is unregulated industry and biggest spreads than the traditional finance is very arbitrage. So say you want to buy an exotic swap on something or you want to lend money or something. You go to Morgan Stanley. They charge you 5 basis points. There is Goldman Sachs across the street who can say, oh, I can charge 4, and you go to Goldman Sachs. So they basically arbitrage it to a very low point. In crypto, though, there are not much players who can do such things, and they are not regulated. So the spreads are bigger. And lots of shrewd investor or like GPs or investment managers, they build this investment strategies and algorithms around these Web3 spreads and Web3 opportunities and try to capture this LP cash flow into their businesses. I can go deeper into details like how the hedge fund works. They have the centralized risk management. So say I'm a Fortress or I'm Millennium or I'm Citadel, one of the biggest hedge funds, right? I basically hire 100 independent units, 100 independent investment teams. I give them money proportionally on in the weights that I want to. And then I manage their risk in a central way. So they invest wherever they want to, but I manage the risk essentially. So say there will, if the team will completely go broke and lose all its money, I would risk maybe like 2% of overall portfolio. So it makes it very risk adjusted for investors to invest in these investment vehicles. And that's actually one of my ideas to create, like say, Fortress in crypto or like Citadel in crypto, which basically just combine a bunch of market making and arbitrage firms, say at least 20, into one marketable product. And built a centralized risk management based on Markowitz theory on top of. I mean, I threw in a lot of details, technical details, which our viewers may not have the idea of what I'm talking about in terms of technicalities. But yeah, whoever understands this, yeah, we can talk about this because I think it's a pretty interesting concept to copy basically Fortress and make a crypto fortress.
Yeah, I think it could be nice, but it actually, what you described sounds like a very, very large and difficult machine.
Yeah,
And
it's a huge machine. Yeah.
from what you, other things that you hear about like Wall Street is that it's really tough, and people are actually burning out a lot, and leaving actually Wall Street for Web3 projects. Is it really like that, and why does it
Yes.
actually happen?
100%. I mean, TradFi people that I've seen, yeah, it's so I've seen a Citadel trader that was on sabbatical because he couldn't do it anymore. So say you have this structure, right, where it's like 100 team within Citadel, and if you not perform, you out. Like if you lose, if you have average performance, okay, they might like, okay, maybe you can stay for another month or another 2 months. But if your performance is still average, they might get rid of you and give the money to somebody who's performing better. And this performance, I would say it's of course it's a skill-based performance, but there is lots of a
Luck.
huge luck component of it. So every day you have to be on your mental peak capabilities in order to keep getting profits, and it eats you alive basically because you have to always make money, and the second you stop making money you're out and there is no career for you anymore. So for them it's very risky it's a very risky career. I mean, if you're talking about sales and trading, say, investment banking is the same, and I've seen lots of people at the conferences with the background of traditional finance who transfers to crypto their careers, because in crypto there is not that the competition is not fierce. I mean, people with their level of understanding, they are not that confident in crypto, so they have this slack room for their mistakes. So if you make mistakes in crypto arbitrage, it's fine. The next day, nobody's gonna fire you, or the next day you still be all right because there is nobody to replace you with. So that's why I see people are moving into the new infrastructure, just because it's not that competitive at the moment.
Yeah, and the market is very fresh and new, so to say.
Yeah,
And
exactly. Yeah.
I think since 2021, there was an interest since 2017 in crypto. They started gradually to be more and more interested in how it works, but more people started to come to crypto from traditional finance, and after the last bull run, I would say. But still, the market is very new, and there's lots of room to grow, and I think it's much less competitive if we compare it to traditional finance. And it's really interesting to see how it will evolve in the crypto space with the traditional finance guys.
It's definitely gonna
And
be more tough for people with less skills, I would say. Because before that, I've seen lots of crypto people with basic understanding, with no fancy degrees or like, who manage and to pull off some big projects, I would say. At the moment, I mean, they're gonna be competing against Harvard graduates, so it's gonna be a bit harder for them.
On one hand, yes. On the other hand, it is also important to understand the crypto community, the crypto people, because they have a bit different mentality and this whole decentralization mood. You also have to get it. If you don't get it, you can't make proper results. So
100%, yeah, I agree on that, yeah.
my point of view. And now I want to touch the most probably interesting topic for any founder is funding, getting investments, and you had some experience. You were investing yourself into some projects. Can you tell us what makes what makes a crypto project really interesting for investors, and how I, as a founder of a crypto project, can get money?
Yeah, sure. So I think that the best way to get investment, right, to build some product that makes money or provides value to its users. I haven't came across a formula of how you make a investable product like out of thin air. You have to find a niche or a spot where you actually provide some value. If you're not talking about this short-term meme coin craze or stuff like that. So I wasn't part of that. To me, it's hard to comprehend, even though I have lots of folks in my network who made tons of money in that. So my thesis is I'm a value investor. Like I'm looking for a value. And in order to get getting an investment, I think it's easy. I think that's the easiest part when you have the fundamentals right. I mean, you have a vision in your mind of how this business improves people's lives or makes the processes more efficient or better or faster. And if you have this vision and you can translate it, investors will be competing to give you money. So I have an example where I met co-founders of they're 20 years old. Um, they live in Boston, and but they have the vision of they build in a I wouldn't name the product yet, but they build in a crypto product, and I trusted them. Like I can see their like where they are feminized with their ideas, and I was the one who were connecting them to different people that I know in my network that I know would be helpful for them. So if you have that, people will find you. You just give the word out, and those people will connect you to the right investors. So finding an investors and getting investments is easy once you get the fundamentals right. And that
Okay.
that is another story, right? How to get the fundamentals right.
So basically, to be attractive for an investor, you have to have a vision, you have to show value,
Yeah. I
and
think
yeah,
that
there should be probably some chemistry between the investor and you. But what is the red flag? What is a no go?
if you want to raise money from I think from investors. So say when I have some businesses which I were sure of, I didn't want to raise money from investors because I want to keep as much equity to myself as I want as I can, right? Just because I'm gonna be diluting myself by letting somebody into my business, and if I believe this business is so valuable and is gonna be I don't know, a big company, I want to keep all the equity to myself. With today's tools, you don't actually need that much of an investment. I mean, you can build everything kind of like you can get the MVP rolling, I mean, by yourself. In most cases, especially with this AI craze, I've seen that people are raising like 5 million for an AI agent. I I don't know, one can build in 3 days for $100. I would say that people who's aim to raise some money from investors, they already dead in the water. Like it's not like you don't want to raise money from investors. Like, why would you sell your company that is so valuable? And I think that's also referring to the first question. If you don't want to sell, there will be investors who want to buy. But if you want to sell, if your whole idea is to build a compelling pitch deck and sell this idea in these early stages, I mean, I wouldn't invest myself, and people I know they wouldn't invest either. We are not
Okay.
the end user. Like, why would we lose our money? Just we are not buying your fancy pitch deck. We are buying the future business of yours. I don't care.
But it happens sometimes that people want to have some funds to develop a project, and this
Yeah,
is
I mean,
why they
absolutely.
need investments.
Yes, but usually the way I've seen it works, when you have a nice business, my money will be given into your pocket. So it's not like, yeah, for sure you need some different scales of ideas. I mean, OpenAI has raised, I don't know, like 400 billion recently. Like, for sure, it's a huge investment, even though like it's one of the best businesses in the world in the moment, right? They still raise money. But my point is like for the in most, right? If you'll take normal distribution, I mean, the majority of the businesses, the whole aim is just to raise funds and whatever. So my businesses, like I've built a startup with investments, the first one. Now I have some ideas. I won't be any, like to me, I'm not raising anything. I just want to grow organically. Like to me, I mean, $10,000 is my max budget to test the idea, to get the first money inflows from clients, not from investors. And if it works, and I can see that okay, this business works, this I can grow it, and then maybe at the later stages, just to scale it up, I can raise some money. But it's a whole different story. Like it's not. It's like you already you don't have to sell to investors. You just have to give the word out that you're scaling and you need some money, and investors will come to you.
Okay, okay, I see. Yeah, when you have a running business which makes money, you're not really interested in someone else's money because you already have it sorted out. But if we're talking about just the project which is really fresh and new, you're not sure if it works and how to be in this case.
Yeah, you need money, so you pitch the idea. So I mean, so my friends of mine, they raise money, they have nothing. They have literally nothing. Like they just have it was word based. Like they had the conversation, and you can kind of feel the value. You can see, okay, this is cool. This has some substance, and nobody cares about these small nuances, like what to get it right, like or what financial model is only used for like shading some logic, like how the founder thinks. So basically, if there is, what's their way of thinking, like do they have what kind of assumptions they make, how deep is their thinking process. So that's the numbers. And if you're talking about this particular startups, right, where is no product, it's basically pure assumptions, right? You have just an idea of a new, I don't know, blockchain, and you want to build a new blockchain. You have no inputs whatsoever, so you build these financial models, you build this pitch deck, and you basically write in a story of your idea, but the only thing that the investors I'm looking for in those is just basically the assumptions they make, the depth of thinking. Like, okay, so what's going to be in this scenario, in this scenario, in this scenario, how they see the future possible turn of events, and that's it. And if it's smart enough, if it's good enough, if I believe in their thinking, okay, that's to me that's enough.
Okay, nice. And what about the person who is looking for investment, like the profile of the founder?
I,
Does it play a crucial role?
I don't. I mean, you have to be trustworthy, I think, right? You have to walk the talk, as they say. But I've seen different kinds of founders, really. So in the US, I've met two teams who raised one 15 million, the other one 20 million. They're 20-year-olds. I mean, what kind of profile is that? They have no experience. They have, I mean, you can say, oh, you have a background in big tech or something like that. That 20-year-old, they barely got off their second course of like the second year university classes or something like that, and they still raised the money because they had this substance in their vision. Like you can see that these founders, they have something, and it's sufficient enough. So. And I've seen the founders who like, I don't know, 50-year-olds that they're starting the first business. Still fine. I mean, still as long as you can see that the person knows that he would be committed to this idea and be willing to overcome the obstacles and have some sort of vision of the end goal. And the end goal makes sense.
And what about pitching the project? How do I pitch a project without sounding like a scam?
Just don't be a scam. Don't build a scam and you won't be sounding like a scam.
Well, I mean, like if we're talking about Web3, there are lots of different scams. And what makes investors think that this might be something shady?
I mean, if you are worrying about not sounding like a scam, most definitely building a scam. So if you worry about that product, I mean, you already have big problems. I mean, to me, just don't build a scam. It's simple. If you're not building a scam, investor with the money, I mean, he got his money somehow. It means that he can make some good decisions, at least decent decisions. At least he understands how money works to some extent. So if you're not building a scam, if you're genuine in your purposes and the value and the business and the end goal vision that you're trying to accomplish, and you can convey that, I don't know, even with no words. They basically sing a song for like 2 minutes, how great their company is. And it was just basic pure rhymes with no proper data. They were like, oh, Wonder is cool, Wonder is great, everybody can use Wonder, or something like that. So that's it. That was their pitch. But you can see in their eyes that, or like, I don't know, you can actually feel it, that they are committed to the idea and they want to make it cool. Like, it's more like it's intangible. I would say there is no perfect form. Like, I mean, it's not like you have to wear a black tie and sit in the suit in the right posture like this and only say the right words that you've memorized before. I mean, that it's probably, yeah, it's mostly looking like a scam. But if you're genuine, like, people can feel it. Like, just be genuine and just convey the end vision with whatever means you have available. You don't have to, I know, proper oral skills or writing skills or design skills. You just basically, you have to be able to write your end goal in the napkin in a couple of sentences, and just say those couple of sentences to the investors. Say, I want to build a casino. That's it. And if I understand, oh, okay, it's called decentralized casinos. And if I'm saying that I'm building a decentralized casino, that's more than enough to get the investors interested. And then you can talk like technicalities with them. And if you are building a scam, they're gonna see that you don't have the technicalities right. So I mean, people who are building the scam, they don't match these nuances. And if you are genuinely build it, you have all the nuances figured out. Or at least if you don't know something, you actually say, oh, it's a good question, I'm gonna write it down and I'm gonna figure it out. And that's it. So I think that's my practice, basically, my experience.
Cool. Thank you. You shared so much valuable information with us today. And just one final question.
Sure.
What would be your main financial advice to Web3 crypto founders? Web3 founders.
Next. Oh yeah, for sure. Oh, I have a perfect one. Get the bookkeeper. Not fractional CFO is the next step. First, get your books right. I mean, QuickBooks, or I don't know, I mean, Excel is fine, but uh, don't mess up your financials, basically. Don't make it, always write it down, and write it down in a organized or structured form, that you can understand, and a random person you can show can understand. Mess it up at the beginning, it will be so hard to then rearrange the tables and build a proper one afterwards. It's like building a building. If you get the foundation right, you can build a tall building. If you get the foundation wrong, I mean, your building will be shaky. You have to scrape it off, and you have to build. If you want to build a nice building, you have to again build a nice foundation and then build the building. So always start from the foundation, I would say.
Great. Nice advice. Thanks a lot. And that was it. Thank you for joining us today. And for our viewers, don't forget to like, subscribe, and comment this video. And so see you soon in the next episode. Thank you. Bye bye.
Thank you. Thank you all. Thank you, Tanya.